Hello everyone and welcome to our channel. Today, we're going to be discussing the economic turmoil in Indonesia, the largest economy in Southeast Asia. While some people still associate Indonesia with the beaches of Bali and its abundant mineral resources, the nation has recently made headlines, or more accurately caused panic, due to currency issues. With a population of over 280 million, Indonesia has the largest economy in Southeast Asia. Yet just earlier this week, its currency, the Rupiah, plummeted to a record low against the US dollar. Do you know the current exchange rate? It's approaching 1 to 17,000. This means that to get 1 United States dollar, you would need nearly 17,000 Indonesian Rupiah, a staggering figure and the worst record since the inception of the Rupiah. Even more puzzlingly, this depreciation isn't due to a stronger US dollar. Usually, when many countries' currencies depreciate, it's because the US dollar is appreciating, forcing them to follow suit. But this time is different. In fact, the US dollar index has been falling recently. Since the beginning of 2026, the dollar has dropped by 2.3%. Major currencies such as the euro and the yen have been appreciating, and even the currencies of neighboring Southeast Asian countries such as the Thai, Baht and the Malaysian ringgit have risen by over 1%. Yet the Indonesian Rupiah is bucking the trend by depreciating relentlessly. Since December 2025, it has fallen by 4.7% in just over a month. On the 19th of January, it even broke below previous lows, hitting its worst level on record. This raises the question, why are other currencies rising while the Indonesian Rupiah is falling? The core reason is simple. Investors have lost confidence in the Indonesian market and are rushing to withdraw their capital. A nation's currency essentially serves as a barometer of economic confidence. When domestic and international investors perceive a market as unsafe or lacking in prospects, they convert their rupiah into hard currencies such as the US dollar or the euro and transfer those funds abroad. This increases the supply of rupiah in the market while boosting demand for dollars, which naturally drives down the rupiah's value. Let the data speak for itself. A report released by Bank Indonesia on the 22nd of January reveals that, throughout 2025, foreign capital saw a net outflow of $8.7 billion from Indonesia's securities market. Foreign investors alone sold $6.4 billion worth of government bonds, while the stock market saw an outflow of $2.3 billion. Entering January 2026, this trend intensified dramatically. In the first 20 days, foreign investors sold another $1.2 billion worth of Indonesian government bonds, while the stock market saw an outflow of $430 million. Furthermore, it's not only foreign capital that is fleeing. Indonesian domestic companies and citizens are also panicking, all scrambling to exchange rupiah for dollars as a precaution. This caused Bank Indonesia's foreign exchange reserves to drop by $3.2 billion in just 1 month, leaving them at $156.5 billion. While this level of reserves is not yet low, the rapid pace of decline clearly demonstrates how severe market concerns about the rupiah have become. Some might ask, isn't Indonesia's economy doing quite well? Why such investor pessimism? From an economic fundamentals perspective, Indonesia achieved GDP growth of 5.0% in 2025, with projections pointing to growth of 5.1% in 2026. Against the backdrop of a slowing global economy, this performance is commendable. Inflation has also been well managed, with an annual rate of 3.2% in 2025, squarely within Bank Indonesia's target range of 2 to 4%. Given stable economic growth and inflation, shouldn't the currency hold its value? The problem lies in confidence. While economic fundamentals are hard data, investor confidence is a soft factor. Once this soft environment collapses, even the strongest hard data becomes meaningless. The International Monetary Fund (IMF) has recently clarified that the rupiah's depreciation is not due to weak economic growth, but to excessive policy uncertainty. Investors lack confidence and are reluctant to commit further. So what lies behind this collapse in confidence? Let's start with the external environment and global pressures. The current global geopolitical landscape is exceptionally turbulent. The Russia-Ukraine conflict has raged 4 years without resolution. The Middle East remains unstable, with new tensions emerging as the Red Sea shipping crisis eases. And Sino-US trade friction fluctuates between escalation and de-escalation, maintaining constant uncertainty. In this environment, global investors have become extremely cautious. No one wants to invest in high-risk areas. Instead, funds are being shifted into safe haven assets such as the US dollar or gold. Emerging market nations like Indonesia are often the first to be abandoned by investors. Why? Because most emerging markets share common vulnerabilities, such as high dependence on foreign capital, limited foreign exchange reserves, and relatively monolithic economic structures, resulting in poor resilience to shocks. Indonesia is a prime example of this vulnerability. Foreign investors consistently hold around 30% of its government bond market, meaning 1/3 of its sovereign debt is owned by outsiders. Furthermore, Indonesia's economy relies heavily on exports, accounting for almost 30% of its GDP. Commodities such as palm oil, coal, and tin make up 45% of its total exports. When global geopolitical tensions escalate, commodity prices fluctuate, which has a direct impact on Indonesia's export revenues. At the same time, panicked investors begin selling government bonds and withdrawing capital. How could the Rupiah avoid depreciation under this dual pressure? In 2025, foreign investors offloaded $6.4 billion worth of Indonesian government bonds, a staggering figure and the largest annual sell-off since 2018. But breaking it down, the divestment occurred primarily in 2 waves. The first hit in September 2025, coinciding with a pivotal decision by Indonesian President Prabowo to replace Sri Mulyani, who had served as finance minister for several years. Mulyani was renowned as a fiscal conservative, known for her cautious approach and strict control over the fiscal deficit, and had earned significant trust from foreign investors. Her replacement, economist Sri Mulyani, advocated for aggressive growth. Investors immediately sensed a policy shift, triggering panic and leading to the sale of $1.8 billion in government bonds within a single month. The second period occurred from December 2025 to January 2026. As the 2025 fiscal deficit data was released and rumors surfaced about a potential change in central bank leadership, foreign capital exited at double the previous pace, offloading $3.2 billion in government bonds over 2 months. This caused Indonesia's bond yields to surge. On the 19th of January 2026, Indonesia's 10-year bond yield reached 6.33%, marking a new high in over a year. Rising yields meant higher borrowing costs for the government, fueling investor fears about repayment capacity. Thus created a vicious cycle of the more they sold, the more yields rose. The more yields rose, the more they sold. Beyond geopolitical tensions and foreign capital flight, global financial market volatility further compounded Indonesia's challenges. Throughout 2025, the inconsistent pace at which the Federal Reserve cut interest rates left markets uncertain, triggering chaotic capital flows worldwide and heightened short-term speculation. Indonesia's high dependence on foreign investment made it a prime target for speculative capital, causing the rupiah to fluctuate wildly with each inflow or outflow of capital. Meanwhile, the United States is set to introduce new tariff policies in early 2026. There are growing concerns that the US may impose additional tariffs on manufactured goods from Southeast Asia. Given Indonesia's significant reliance on manufacturing exports, any tariff hikes would further erode export revenues. These anxieties have also spilled over into the currency markets, accelerating the rupiah's depreciation. Having addressed external pressures, we will now turn to the more fundamental internal issue of Indonesia's domestic policies, particularly its fiscal deficit, which is approaching the statutory red line at an alarming rate. This is the real reason investors have lost confidence. According to data released by Indonesia's Ministry of Finance on the 9th of January, the fiscal deficit for 2025 reached 695.1 trillion Indonesian rupiahs, approximately 46.3 billion United States dollars, representing 2.92% of GDP. To put this figure into perspective, firstly, it marks a 36.5% surge from 2024's 2.3%, an exceptionally rapid increase. Secondly, it exceeds both the initial budget target for 2025 of 2.53% and the adjusted target for the second half of the year of 2.78%. Most critically, Indonesian law explicitly stipulates that the fiscal deficit must not exceed 3% of GDP. The 2025 deficit of 2.92% is just 0.08 percentage points below this threshold, effectively teetering on the edge. This is the highest level since the start of the pandemic in 2020. Some may ask, what harm can a slightly higher fiscal deficit cause? Why are investors so concerned? Here's some background. Indonesia's 3% fiscal deficit cap was introduced following the 1998 Asian financial crisis. During that crisis, many Southeast Asian nations, including Indonesia, suffered currency collapses and economic bankruptcies due to excessive fiscal deficits and debt burdens. Consequently, post-crisis legislation was introduced in the form of the state finance law, which capped deficits at 3% in order to enforce fiscal discipline, mitigate debt risks, and bolster market confidence. Since the law's implementation, Indonesia has consistently kept its deficit below 3%, except during the peak of the pandemic in 2020 when the deficit hit 3.49% due to exceptional circumstances. This fiscal self-discipline is a key reason why foreign investors trust Indonesia. However, when the deficit surged to 2.92% in 2025, just below the red line, investors immediately panicked. Does this mean the government is loosening fiscal discipline? Might it breach the 3% threshold in future? If so, could government debt spiral out of control? What if it cannot repay maturing debts? Such concerns naturally deterred investors, prompting them to withdraw funds, a move that directly accelerated the rupiah's depreciation. So why did Indonesia's fiscal deficit increase so dramatically? The core issue is spending more than it earns, with the gap steadily widening. In 2025, Indonesia's government revenue was 2,756.3 trillion Indonesian rupiahs, which was 3.3% lower than in 2024. However, fiscal expenditure reached 3,451.4 trillion Indonesian rupiahs, which was 2.72% higher than in 2024. With revenue declining and spending rising, the deficit naturally widened. The decline in revenue stems primarily from two factors. First, weak exports. Indonesia's total exports fell by 2.8% in 2025, with commodity exports such as palm oil and coal dropping by 3.3%. Lower exports mean reduced government export tariffs and related tax revenues. Secondly, domestic tax collection also missed targets. Slowing economic growth has caused difficulties for many small and medium-sized enterprises, resulting in reduced tax payments. Domestic tax revenue fell by 2.1% in 2025. Meanwhile, increased spending was largely driven by President Prabowo's efforts to stimulate economic growth. Upon taking office, he set an ambitious target of achieving an 8% economic growth rate for Indonesia by 2029, with current growth hovering around 5%. Reaching 8% will require significant investment, particularly in infrastructure. In 2025, government spending on infrastructure projects such as roads, railways, and ports increased by 8.2% year-on-year. At the same time, in order to counter commodity price volatility and safeguard public livelihoods, the government increased subsidies for fuel and food, resulting in a 5.3% rise in social subsidy expenditure. With revenues declining while expenditure is surging, it's no surprise that the deficit is approaching critical levels. Although Finance Minister Sri Mulyani Indrawati has repeatedly emphasized at press conferences that the 2.92% deficit remains within manageable limits and has not impacted economic stimulus plans. Investors remain unconvinced. They are concerned not whether it is manageable now, but whether it will spiral out of control in the future. if the government continues to ramp up spending in order to achieve its 8% growth target. Next year's fiscal deficit could easily exceed the statutory 3% threshold. Crossing this threshold would trigger greater market panic and could prompt international credit rating agencies to downgrade Indonesia's sovereign credit rating. This would raise the government's borrowing costs and intensify economic pressures, creating a vicious cycle. If investors were concerned about the fiscal deficit, the next development sent them into a panic. Indonesian President Prabowo appointed his nephew as deputy governor of the central bank. Crucially, this nephew has already served as deputy minister of finance. This personnel change has sent shockwaves through the Indonesian market and further intensified pressure on the rupiah's depreciation, with the government to formulate fiscal policies and help achieve economic growth targets. However, the role of deputy governor of the central bank focuses on maintaining currency stability, controlling inflation, safeguarding the financial system, and formulating monetary policy. It is important to note that the duties of these two positions inherently conflict. The Ministry of Finance seeks to stimulate the economy by urging the central bank to print more money and lower interest rates. Conversely, the central bank aims to stabilize the currency, which may require tightening monetary policy and raising interest rates. Having one person hold both roles risks one priority being neglected in favor of the other, potentially subordinating monetary policy to fiscal policy and eroding its independence. Compounding market concerns is the fact that Thomas is the president's nephew. This familial connection inevitably raises investors' suspicions about whether this appointment constitutes nepotism. Is the president seeking to control the central bank's monetary policy through his nephew, forcing it to align with his economic growth targets? It is important to note that Indonesia's central bank has historically been free from government interference, which is a key foundation for foreign investors' trust in the country. However, this appointment shatters that perception, leaving investors anxious. Will the central bank base its policies on economic data or the president's preferences? Will it prioritize monetary stability or political demands? On the day the news broke, the 19th of January, Indonesia's markets experienced a Black Friday. The rupiah depreciated by 0.8% against the US dollar in a single day, reaching a 9-month low and then continued to decline, setting a new record low. Yields on Indonesia's 10-year government bonds surged by 15 basis points to reach 6.33%. The Jakarta Composite Index plunged by 1.2%, marking its steepest single-day drop since December 2025. Foreign capital exited at an accelerated pace, with net sales of $210 million in government bonds and $130 million in stocks recorded that day. International financial institutions voiced concerns, with one stating explicitly that the appointment cast serious doubt on the independence of the Bank of Indonesia, which will continue to put pressure on the rupiah and bond markets. In response to market panic, the Indonesian government and central bank moved quickly to reassure investors. The finance minister stated that Thomas's appointment would not affect the central bank's independence, and that the ministry and Bank Indonesia would maintain their respective roles while coordinating closely. The central bank also issued a statement affirming its continued focus on stabilizing the rupiah and controlling inflation. It emphasized that personnel changes would not affect the professionalism of its monetary policy. Members of parliament also spoke in support of Thomas, highlighting his competence and experience as suitable for the role. However, investors remain unconvinced and are voting with their feet. They are not willing to bet on claims of independence remaining intact. Rather than risking further depreciation, they are withdrawing funds to protect their capital. This perpetuates the pressure on the rupiah to depreciate. Some may still wonder, why is central bank independence so crucial? Why do investors care so much? Let me illustrate with an analogy. The central bank acts as the gatekeeper of a nation's currency, primarily responsible for maintaining monetary stability and controlling inflation. It's like the housekeeper in a family, responsible for managing the household finances, ensuring that money isn't squandered or printed recklessly, and safeguarding the family's financial security. However, the government is like the head of the household. They may pressure the steward to allocate more funds, or even print more money, to achieve short-term goals such as building houses or buying cars. Without independence, the steward would have no choice but to comply, leading to reckless spending and excessive money printing. This would ultimately devalue the currency, trigger soaring prices, inflation, and cause the household's finances to collapse. Since the 1998 Asian financial crisis, Bank Indonesia has prioritized independence, setting clear inflation targets and maintaining transparent monetary policy decisions in order to signal its intentions to the markets. This has attracted long-term foreign investment and stabilized the rupiah. However, the central bank's independence has eroded in recent years. In September 2024, the central bank and the Ministry of Finance signed a burden-sharing agreement requiring the central bank to fund the government's affordable housing projects directly, breaking the long-standing convention against government financing. This immediately sparked concerns in the market. Now, the president has appointed his nephew to the central bank, further fueling market concerns. Many believe that the independence of the central bank may truly be at risk. Consider the consequences if the central bank were to lose its independence. In order to achieve the president's target of 8% economic growth, he could put pressure on the central bank to cut interest rates and print more money in order to stimulate investment and consumption. But what would be the consequences of excessive money printing? This will lead to an oversupply of currency, the further depreciation of the rupee, and soaring inflation. Furthermore, if the central bank were forced to finance the government's fiscal deficit, it would essentially be printing money for government spending. This would cause the fiscal deficit to balloon and government debt to spiral, which could ultimately trigger a currency collapse and economic crisis. Many nations have suffered this fate historically. During the Asian financial crisis of the 1990s, for example, Thailand and Malaysia saw their currencies plummet and their economies collapse precisely because their central banks lost independence by accommodating government economic policies to excess. Aware of these historical lessons, markets are particularly sensitive to the independence of Indonesia's central bank. When news of this personnel change emerged, investors showed no patience and immediately chose to sell assets and exit the market. This voting with their feet may appear aggressive, but fundamentally reflects investors' instinctive risk aversion. I can't predict future problems, but I can choose to avoid them now. This panic-driven exodus has accelerated the rupiah's depreciation, transforming a gradual decline into a precipitous plunge. The pressing question on everyone's mind at this point is what impact the relentless depreciation of the rupiah will have on Indonesia's economy. Will ordinary citizens feel the effects? The answer is unequivocally yes, and the repercussions will be significant. The most immediate consequence is rising import costs. Although Indonesia is resource-rich, it relies heavily on imports for many core commodities. For example, 30% of its crude oil consumption is imported. 25% of fixed asset investments are in machinery and equipment, and 40% of domestically consumed pharmaceuticals come from abroad. As the rupiah weakens, the cost of purchasing these goods increases, driving up production costs for businesses and raising prices for consumers. A report by the Indonesian National Importers Association in January 2025 revealed that, since the rupiah began depreciating in December, import costs for sectors such as pharmaceuticals, cosmetics, and steel have risen by between 5% and 8%. Many companies have no choice but to raise product prices, passing these costs on to consumers. For example, the price of a bottle of imported shampoo has risen from 10,000 rupiah to 10,800 rupiah, and the price of a ton of steel has risen from 5 million rupiah to 5.25 million rupiah. For ordinary citizens, stagnant wages and rising prices significantly increase the pressure of daily living. For businesses, rising costs erode profits, potentially deterring expansion and even leading to layoffs, which has an impact on employment. Secondly, the depreciation of the rupiah places immense pressure on Indonesia's repayment of external debt. According to data from Bank Indonesia, Indonesia's total external debt reached $402 billion by the end of 2025. accounting for 38.7% of GDP, with 72% denominated in US dollars. What does this mean? It means that the majority of money borrowed by the Indonesian government and businesses is priced in US dollars and must be repaid in US dollars. A depreciation of the rupiah would drastically increase the cost of servicing these debts. For instance, a $100 million debt incurred when the rupiah was valued at 15,000 against the dollar would require repayment of 1.5 trillion rupiah. With the current exchange rate of 1 to 17,000, repayment would now be 1.7 trillion rupiah, an additional 200 billion rupiah, equivalent to a 13% increase in repayment costs. In 2026, Indonesia will face $52 billion of maturing foreign debt, $36 billion of which is denominated in US dollars. This massive repayment burden, compounded by the depreciation of the rupiah, will create severe hardship for the Indonesian government and businesses. Small and medium-sized enterprises (SMEs) with significant foreign debt and low foreign exchange earnings are particularly vulnerable, potentially facing the risk of default or even bankruptcy. A wave of corporate failures could destabilize the financial system, leading to rising bank non-performing loan ratios and potentially triggering a financial crisis. Furthermore, rupiah depreciation will increase government fuel subsidy expenditure, since domestic fuel prices are government-regulated. Rising import costs necessitate higher subsidies to prevent excessive domestic price hikes. This further widens the fiscal deficit, creating a vicious cycle of depreciation. Increased subsidies, expanded deficits, and further depreciation. Thirdly, rupiah depreciation may trigger a resurgence in inflation. Although Indonesia's inflation rate currently remains within the 2 to 4% target range, with the annual rate in 2025 at a manageable 3.2%, rising import costs are gradually feeding into domestic prices. The Bank of Indonesia itself forecasts that if the rupiah continues to depreciate, inflation could rise to 3.8% by the second quarter of 2026, approaching the upper limit of the target range. Once inflation rises, citizens' real purchasing power declines. For instance, if someone previously earned 1 million rupiah per month and could purchase 100 kilograms of rice, inflation could mean that they can now only afford 95 kilograms. Furthermore, rising inflation could force the central bank to raise interest rates and tighten monetary policy, which would conflict with the government's goal of stimulating economic growth. This dilemma means the central bank must choose between raising rates and risking slower economic growth, or not raising rates and risking inflation spiraling out of control. So the question arises, is the depreciation of the Indonesian rupiah merely a temporary market fluctuation, or is it the beginning of a larger crisis? The answer lies with the Indonesian government and hinges on two key factors. Firstly, whether it can rein in spending and keep the fiscal deficit below the 3% threshold. Secondly, whether it can restore market confidence in the central bank and safeguard its independence. Success in these areas could limit the impact of the current turmoil. Failure could lead to a wider-reaching economic crisis. Firstly, regarding fiscal spending, the Indonesian government has stated that it will implement measures in 2026 to cut non-essential expenditure and optimize spending structures, such as scaling back unnecessary infrastructure projects and reducing administrative costs. At the same time, it will strengthen tax collection, crack down on tax evasion, and increase fiscal revenue, with the aim of keeping the 2026 fiscal deficit below 2.7%. The question remains, can these measures be effectively implemented? President Prabowo's target of 8% economic growth requires substantial capital investment. Cutting expenditure now could jeopardize achieving this growth goal. Whether the government can strike a balance between sustaining growth and maintaining fiscal discipline will be a significant test of its governance capabilities. If it pays mere lip service to spending cuts while continuing to ramp up investments and widen the deficit, market confidence will be permanently eroded. Turning to the market's foremost concern, central bank independence. Thomas's nomination is still under parliamentary review and its ultimate approval is uncertain. Should Parliament reject the nomination, or require Thomas to resign as deputy finance minister in order to serve solely as deputy governor of the central bank. Market anxieties might ease. However, if the nomination is approved and Thomas holds both positions, the central bank's independence will be in jeopardy. Regardless of whether Thomas ultimately takes office, it is crucial that the Bank of Indonesia's future monetary policy decisions remain transparent, professional, and free from government interference. The central bank must demonstrate through concrete actions that it remains an independent gatekeeper rather than the government's piggy bank. Only then can investor confidence be restored. Indonesia's economy possesses considerable resilience itself. It holds ample foreign exchange reserves, $156.5 billion, sufficient to manage short-term capital outflows and external debt repayments. Its economic fundamentals remain robust, with growth rates of around 5%, which is solid by global standards. Furthermore, Indonesia boasts abundant resources, a significant demographic dividend, and substantial long-term development potential. The IMF recently noted that Indonesia can manage current exchange rate volatility effectively and achieve sustainable growth by maintaining policy credibility, preserving policy space, and accelerating structural reforms. The Indonesian government is currently implementing a series of measures to stabilize markets. These include requiring companies to convert a portion of their export earnings into Rupiah to increase the dollar supply in the market, utilizing foreign exchange reserves to intervene in the currency market by buying Rupiah and selling dollars to stabilize the exchange rate, and strengthening capital flow management to prevent excessive short-term capital speculation. While these measures may provide short-term support for the Rupiah, addressing to core issues, fiscal deficits and central bank independence, is essential to fundamentally curb its depreciation trend. In summary, the Rupiah's plunge does not stem from a single factor but from a convergence of global geopolitical tensions, foreign capital outflows, a fiscal deficit approaching critical thresholds, and a confidence crisis triggered by changes in central bank leadership. While it appears to be a currency depreciation issue on the surface, at its core it reflects the Indonesian government's dilemma between growth preservation and currency stabilization, a crisis of policy, credibility, and central bank independence. The most critical task for Indonesia now is to stabilize market confidence before attempting to stimulate economic growth. Only by effectively controlling the fiscal deficit and maintaining the statutory 3% threshold can the government convince investors of its fiscal discipline. Only by safeguarding the central bank's independence can investors have faith in the competence of monetary policy. Transparent and stable policies are key to gaining investor confidence, leading to the return of foreign capital, stabilizing the Rupiah exchange rate, and realizing long-term, healthy economic growth. However, if Indonesia relentlessly pursues short-term growth targets while neglecting monetary stability and fiscal discipline, it risks repeating the mistakes of the Asian financial crisis and paying a heavy price. Indonesia's situation indeed serves as a wake-up call for many emerging market economies. Amidst global geopolitical turbulence and increased capital flows, only prudent fiscal and monetary policies can withstand external shocks and stabilize market confidence. Over-reliance on foreign capital, the blind pursuit of high growth, and disregard for policy discipline will ultimately leave a country vulnerable. Alright, today we've covered the causes, impacts, and potential trajectory of the depreciation of the Indonesian rupiah. Did everyone follow along? In essence, this issue boils down to two words: confidence and discipline. When investors have confidence, capital remains in place. When governments are disciplined, markets gain confidence. Indonesia's immediate task is to rebuild confidence and uphold discipline. What are your thoughts on Indonesia's current economic turbulence? Do you think the government can stabilize the situation? Please feel free to share your thoughts in the comments section below. I'll also continue to monitor global emerging market dynamics and provide further in-depth analysis in future updates. Remember to subscribe to our channel and turn on notifications so that you'll be the first to know when new videos are released. Finally, thank you for watching. See you next time. Bye.